17 people, $7 billion, and nobody blinks. Every document in this room is someone's ruin. There's one question they ask about every company, and it isn't what the company is worth. It's what survives the wreckage. You're about to find out what it pays to know. If you're enjoying this content, a sub goes a long way. All right, back to it. Level 1, the analyst. You are 23. You came from the restructuring group at Houlihan Lokey or Lazard, where the fund recruited you directly before a bank could. Base salary, $115,000. All in, with your year one bonus, $165,000. The fund has 17 people. It manages $7 billion. The last office you interviewed in had 400 people on a single floor. The silence of this office is the first thing you notice. The specific quiet of a room where everyone is reading something that matters and no one is performing for anyone else. There is no training program. There is a Bloomberg terminal, a shared drive with model templates, and a 260-page credit agreement on your desk on the first morning. The credit agreement is the legal contract between a company and its lenders. It governs what the company can and cannot do with its cash, its assets, and its debt before it defaults. You learn to read it faster than anyone expected. By month 3, you can locate the restricted payments basket, the incremental debt basket, and the asset sale waterfall in under 5 minutes. This is your first real skill, and it is not what you thought the job would be about. Your actual job is building liquidation analyses, not growth models, not DCFs, liquidation analyses. Because in distress investing, the first question is never what this company is worth as a going concern. The first question is, if everything stops tomorrow, what does each layer of the capital structure recover? Senior secured lenders take the collateral first. Unsecured bondholders get what remains. Equity holders get nothing. You build the waterfall. You find where the value breaks. The instrument sitting exactly at the break point, the one that gets some recovery but not a full recovery, is called the fulcrum security. The fund that owns the fulcrum security controls the restructuring. That is the entire game, stated plainly. You spend your first year learning to find it. In month 7, you write your first real investment memo. A regional grocery chain. Unsecured bonds trading at 32 cents. Your liquidation analysis puts recovery at 66 to 74 cents. The company owns real estate that no sell-side model has properly valued. The leases are being marked at a fraction of their replacement cost. You stay until 1 in the morning building the real estate comps. The memo is 12 pages. You send it at 2:23 a.m. The portfolio manager reads it the next morning in the time it takes you to pour a cup of coffee. He closes the folder. He looks at you across the desk without saying a word for a long time. You have no idea whether that means yes or no. Level 2, the associate. He says size it. 2 words. That is the complete answer. You build a 0.75% position in the grocery chain's unsecured bonds at an average cost of 34 cents on the dollar. The fund deploys $51 million on your thesis. That number occupies a specific part of your attention for the next 18 months, regardless of what else you are working on. You are 26. Base 160,000. All in, with bonus, 310,000. You now sit on the creditor committee calls for 3 active positions, which means you are in the room or on the line where the real negotiation happens. The creditor committee call is where the fund's lawyers, the company's management, and the other major creditors discuss the structure of the restructuring. You are not speaking yet on these calls. You are listening for what is not being said. Which creditor is quietly coordinating with management? Which lawyer's questions are actually threats? Which proposed term in the plan of reorganization creates value for one tranche by quietly destroying it for another? You learn in month 4 of the associate role that the legal architecture of a bankruptcy is where the money is made or lost. The financial model gets you into the position. The legal document determines what you recover. You begin reading indentures the way you once read credit agreements, looking for definitions and carve-outs that will matter 18 months from now in a courtroom you are not yet imagining. The grocery chain files Chapter 11 in month 9 of your position. You own bonds at an average cost of 34 cents on the dollar. You are senior secured, which means you are first in line to the collateral. Your recovery analysis has you at near par. Then, the Chapter 11 petition hits the docket and you pull the subsidiary exhibit. The real estate portfolio, the entire basis of your thesis, is held in a subsidiary entity that is not in your collateral package. It was transferred there 6 months before the filing date. Not by accident. Someone moved those assets deliberately before you were in the position, specifically so they would be out of reach when the bankruptcy came. Level 3, the vice president. It is called a fraudulent conveyance. The legal theory is that a company cannot transfer assets away from its creditors in anticipation of a bankruptcy. Your lawyers file an adversary proceeding the same morning the petition hits. The litigation runs 11 months. You recover 79 cents on the dollar. Your thesis was correct about the value of the assets. It was incomplete about the legal structure around them. You do not make that mistake a second time in any position ever. You are 30, base 210,000. All in with bonus and your first carry participation, 550,000 in a strong year. You run the creditor committee for 2 active situations now. You are the person in the room who speaks, not the person who listens. Running a creditor committee at this level is negotiation with a legal brief attached. You are trying to get a plan of reorganization confirmed in a form that maximizes your recovery. The management team wants to preserve the equity. The private equity sponsor who owns the company wants to protect their position. The other creditor groups want terms that favor their tranche over yours. You represent your fund's specific location in the capital structure, and you argue it is the correct location to receive the residual value of the enterprise. Being right about the math is not sufficient. The real lever is owning enough of the right instrument to block a plan you do not support. If you can block, you have leverage. If you have leverage, you get the terms. You are assembling a blocking position in a telecommunications company when a name appears in the docket filings. Another fund, they have quietly accumulated 33% of the second lien notes, which is more than enough to block your plan of reorganization. You cannot confirm the plan without them. You need to either negotiate with them or outmaneuver them, and you cannot do either until you know exactly who is in that position. You have seen this blocking structure built exactly once before. You were on the other side of it. Level 4, the principal. It is Centerbridge partners. You have seen their approach before, from the other side of a different trade. They are not trying to block you permanently. They are trying to get paid to remove the block. You arrange a call for Thursday. You offer 4 additional recovery points on their second lien position in exchange for their support on the plan. The economics work for both funds. The plan confirms. 5 weeks later, you are 33. All in compensation with carry, this year, $1,100,000. You originate theses now rather than executing ones that come to you. That means reading macro credit conditions and sector deterioration and capital structure design and identifying the next set of distress situations before the market prices the stress fully. Your best ideas come from reading covenant-light loan documents from 2 and 3 years ago, when credit conditions were loose and companies borrowed on terms that made sense in a different rate environment and no longer do. The current thesis is a media and entertainment company, $1.8 billion in debt, EBITDA declining at 12% annually for 3 consecutive years. The bonds are trading at 54 cents. The market is not yet pricing the full structural deterioration. You have been building a position for 5 months. Your average cost is 49 cents. You own enough of the first lien to control any restructuring outcome. Management is aware the fund is in the position. Management teams always find out. A distressed fund building a large position in a company's debt is not a subtle event. And management teams who know a distressed fund owns their paper at a significant discount have a specific incentive to find a resolution that does not involve your fund controlling the outcome. They contact a competing creditor group without notifying the creditor committee. A restructuring support agreement is signed. You discover it through a footnote in a court motion that lands on the docket at 11:17 p.m. on a Wednesday. The footnote references the agreement and lists the signing parties as undisclosed. Your position is being set up to get crammed down, and whoever designed the structure knew you would find out through a footnote at 11 p.m. when the options for an immediate response are limited. If you've made it this far, you're exactly who this channel is for. A subscribe helps me keep making these. No pressure, but I'd appreciate it. Level 5, the managing director. A footnote at 11 p.m. is how you learn everything important at this level. You have 3 responses built before midnight. The first is a motion challenging the restructuring support agreement as a violation of the automatic stay. The second is a letter to the board of directors that will become public. The third is a direct call to the largest holder in the competing creditor group, a fund you have been on the same side of 2 previous trades with, and who you already know is not satisfied with the terms they were given. You make the third call first. By Friday morning, the competing group has fractured on the economics. By the following Thursday, you are the largest organized creditor block in the case. The management team's strategy lasted 11 days. You are 38. Your compensation is a share of carried interest across the fund's active positions. The fund has grown to $14 billion in assets under management across 3 credit strategies. In a strong year, your cut of the carry is $3,600,000. In a great year, closer to 5.5. In a losing year, the carry does not pay, and you live on a base of $400,000, which at this point in your life feels like what it is, a floor, not a destination. You manage the fund's full distressed book. The principals and VPs below you run the individual situations. You run the capital allocation decisions. The committee votes on new positions. The quarterly LP calls in Abu Dhabi and Toronto and Zurich, where you present the portfolio to sovereign wealth funds and pension plans who have allocated to the strategy. These relationships are the fund's existence. You treat them accordingly. Your senior analyst, the person who sourced the last 4 theses that the fund built meaningful positions around, sends you a calendar invite on a Friday afternoon at 5:53 p.m. The subject line says, important. You do not open it until Sunday evening. Level 6, the CIO. He is leaving to launch his own fund. He already has capital commitments from 2 of your existing limited partners. 3 weeks after his departure, 2 of your senior associates give notice. 1 month after that, another LP rebalances its allocation. The fund loses $400 million in committed capital across those events. You have seen this before from other funds, and you understood it was structural, an inevitable consequence of how this industry retains and loses talent. Understanding it structurally does not change what the month costs. You are 44. You have run the fund's distressed book since you were managing director. You were named CIO when your predecessor left to build a credit platform inside an insurance company. The fund now manages $16 billion in assets. The distressed book is $10 billion of that. 34 people manage $16 billion. The ratio is intentional. The fund has never added headcount faster than it has added analytical rigor, which is a thing you say in LP meetings and which is also simply true. Your return on a single position over the past 4 years defines the shape of your track record. A power generation company. You identified the stress 18 months before the filing, built a position in the first lien term loan at 47 cents, took control of the equity in the Chapter 11 through a loan-to-own conversion, installed a new management team, improved EBITDA by 38% over 3 years, and sold the business to an infrastructure fund last spring at 2.9 times the fund's invested capital. The carried interest on that single investment was $41 million to you personally over the life of the position. The company is healthier today than it was at any point in its history before your fund owned the debt. That is also true. Both things are true simultaneously, and you do not spend time weighing them against each other because the fund has 19 active positions, 3 new situations being underwritten, and the next LP quarterly report is due in 8 days, the final turn. There are 4,300 employees at the power generation company your fund acquired through a Chapter 11 restructuring 3 years ago. Your fund owns 100% of the equity after converting $900 million in debt at a deep discount. You brought in new operational leadership. EBITDA is up 29%. The business is now inside a sale process that will likely return 2.6 times invested capital to the fund. The 4,300 employees are not counterparties in the sale process. They are a line in the EBITDA bridge. The defined benefit pension was modified during the bankruptcy confirmation hearing. Monthly benefits were reduced by 19% for retirees who had no direct representation in the negotiation, whose only counterparty in that room was the Pension Benefit Guarantee Corporation, which is a federal agency with a mandate that does not include preserving the full value of what those employees were promised when they agreed to their terms of employment. The sale will close. The fund will distribute the proceeds to its limited partners. Those limited partners include 3 state pension funds covering teachers, transit workers, and municipal employees across 7 states. The returns from this investment will fund retirements for people whose financial situation is structurally identical to the situation of the people who absorb the loss on the other side of it. The capital traveled one direction. The benefit traveled another. Both populations are real. You have met one group twice a year for over a decade. You have never been in the same room as the other. This is not a problem distressed investing has solved. It is a problem distressed investing has learned to describe in terms that make the question harder to locate. You are at the top of this industry. The question does not get smaller from here. It gets quieter, more diffuse, harder to point to in any single document or any single decision. But it does not disappear. The fund continues. The market opens. There is a consumer goods company whose bonds are trading at 38 cents on the dollar. Your junior analyst put a memo on your desk this morning. You have not read it yet. You pick it up. This video follows private equity from the analyst who builds the first model to the partner who sells the company a decade later. The same capital, the same companies, the same decisions, seen from the side that holds the equity instead of the debt.